Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris McIntire. McIntire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning, guidance, and perspective on our money, on our investments, on our approach to achieving our financial goals for the future. He is president and founder of McIntire Retirement Services. Chris McIntire here with us. And Chris, always an interesting time in the market. We're glad you're here to provide some perspective.
Yeah, it's been a different year this year than last year. Probably going to add a couple of gray hairs to all of us who make a living in this industry, and even to the investors on the sidelines. It's certainly been a year where after 2021, with very little volatility, we certainly have making up for that in 2022, and some of that's bound to happen. A lot of geopolitical forces at play, obviously, the Russia-Ukraine. The energy prices and things along those lines, inflation, supply chain. So a lot of headline issues right there. And, we all hope that we get through some of these issues and can, continue on this recovery method and try to get COVID where it is more of a seasonal, if that's what I want to call it, and entering the endemic stage out of the pandemic. And certainly a lot of countries around the globe, including the United States, are relaxing a lot of the restrictions after Omicron basically infected the entire population, leading to some degree of herd immunity, whatever that ends up looking like down the road with other variants. So, let's hope for better times, of course.
Yeah, and we don't want to make up for lack of volatility, and yet it does seem like we are doing that this year, Chris. Seen some recent instability in the markets. It's actually invoked a lot of emotion, of course. However, just because the market is volatile or we believe volatility could be coming doesn't mean that we should stop our financial progress by any means. Fear should not be driving the car. Fear should not be in control of decisions. If we have a good long-term investment outlook, Chris, we should expect to see some volatility along the way, and maybe there's some opportunity in it.
Yeah, absolutely. And, for those that are long-term investors, some of you are still working, so you want to be contributing into the market while we're having these dips out of your payroll contribution. So that dollar cost averaging that you buy more shares when the market is down than you do when the market is high, is a good buying opportunity for those that are still saving for retirement. For those that are already in retirement, you and I both get emails back and forth from clients that are like, hey, should we take some heat out of it? That type of thing. And, if you rebalance your portfolio, again, that helps you to, help buy on some of these dips as well too. And, staying in line with your overall risk tolerance. And, I think today it's probably safe to say that most investors out there today, their risk tolerance changes from month to month. Not everybody can look at this long-term perspective and, they look at this month's statement to last month's statement, and, all of a sudden their behavior characteristics change quite a bit. And that's probably not the right way to do it. You want to stick with your long-term objectives and not make knee-jerk reactions and that type of thing.
Well, we do want to provide education and guidance on this program, ladies and gentlemen. We want to help you navigate the markets and make sure that your money is working hard to help you achieve your financial goals into the future. And of course, Chris McIntire, our resource for this information and perspective here on the program, but also your resource, ladies and gentlemen. If you would like one-on-one guidance, if you'd like portfolio design, investment, and financial management, if you would like retirement income planning, if you'd like to take a look at the risks that you're taking with your money, the fees that you're paying, the taxes you may be liable for, all of that is part of the game plan for retirement that Chris McIntire will help you put together through a complimentary financial review and strategy session. It's really detailed forensic financial analysis, uncovering everything that's below the hood and making sure everything's clicking and moving forward for your financial progress, regardless of what kind of market conditions we may see in the future. Although we'll talk about what that may hold or what it may mean for us as investors throughout the course of the program. But if you would like to take advantage of that opportunity to really dig beneath the surface and understand what you own and more of what your money is doing for you and how it's working hard to help you achieve your goals, pick up the phone and give McIntire Retirement Services a call, 800-868-1194. That's 800-868-1194, 800-868-1194. You can also go online and always listen to past editions of the program, as well as view many additional resources, reports, information available at McIntyreRetirementServices.com, McIntyreRetirementServices.com. And so, Chris, let's talk about kind of where reality separates from our understanding, a little bit of maybe fact versus fiction, or just where we need to kind of realign our thinking. We've heard that the market always goes up over time, and it sounds like a great thing, but we also need to be aware that along with the market, yes, having gone up over time, often goes down. And we really need to be prepared for those downturns ahead of time and align our plan to account for such.
Yeah, Peter. And, the average, I think, drawdown of the S&P 500 annually is 14%. We did not have one of those in 2021. Again, all that stimulus and everything that came into play. Now we're off of that stimulus, looking at normalized market conditions that, that the federal government or Federal Reserve might not be able to mitigate like they had during the pandemic. So, there are times when the market has substantial losses, like 2000, 2001, and 2002. That was the last real recession that we had to work our own way out of without a lot of government stimulus and that type of thing. We had the 2008 financial crisis. The market fell, call it 30 to 40%, depending on which index you're reading. And then in 2020, we had the month of March where the market fell 20 to 30%, again, depending on the index you're looking at. Some of those have been short-lived because the government comes in and tries to stabilize everything. But if we get another 2000, 2001, 2002, that was 3 painful years and of the NASDAQ lost, what did it lose? 60% of its value in 3 years. So, there are times those things can hurt. And then the recovery time to get back to where it once was can hurt as well. So, I think to your point here, Peter, is if, the market falls by 40% and you're 100% invested in the S&P 500, for example, in an index fund, right? Well, that index has got to recover 64% to get you back to being whole. So again, that's why you have to have some diversified portfolios, stocks, bonds, real estate, commodities, that type of things to, because you never know which one's going to drop quickly. We just saw that with stocks here in 2022, forgive me, just how fast it can happen. And it's hard to hit the sell button and then say, okay, then when do you hit the buy button again? Because if you miss the big recovery days, you're really short-circuiting yourself also by not being in the market when those days occur.
And oftentimes the best days happen fairly close proximity to some of the worst days. Yes, we feel bad one day. We don't want to sell out necessarily because it could bounce right back the next day. Chris, I want to go to one of the points that you mentioned and get your take on it. You said that the dot-com bubble, 2000, 2001, 2002 was the last recession that we had to really work ourselves out of. And that's an interesting comment, because you're right. After the Great Recession, 2007, 2008, here comes the government with trillions of dollars across, I think, 3 or 4 different rounds of what they called quantitative easing, basically throwing a lot of money back into the market, basically buying up a lot of our own bonds. And then in the COVID downturn, here comes the government again with the CARES Act, more trillions of dollars, this time sending $3,000 checks right to the households of the American public. That was a pretty bipartisan support kind of approach there. And B, the people really liked it when they started receiving that money. And it did seem to bounce us back out of that. Do you feel like just throwing money at the problem is kind of the new playbook? And do you feel like maybe into the future, while downturns could be deep and pretty sharp, we may see quicker recoveries as a result, if that is the case?
I would probably argue the other direction, that they've actually made some of these things worse, obviously, because, people are expecting the government to come in and come to the rescue, but they never pay for the things that they've done in the past. Let's be honest, right? I mean, that's why we have a $28 trillion deficit, because they keep spending and not fixing that. At some point that becomes problematic. And, look at the inflation side of things. They put too much money into the system, and now everything costs so much. Again, supply chain issues, right? So, if you're going to give people money to buy goods that are on the shelves, you better make sure there's goods on the shelves that they can buy. And that's part of the problem right now. So, some of this has been, created by the Fed, and everybody wants to get elected, so they certainly are going to pass some of that legislation. Probably be something come up here in about November, as the one political party looks like they may lose the House and the Senate to the other political party, and they're going to probably try to cater favor here and see what they do with gasoline taxes. Right, price of gas is over $4 if you buy diesel, and who knows what gasoline is by the time people are listening to the show here. Obviously, it changes every day. And, I don't know. You and I talked before the show that I think, the current administration wants people to go on to electric vehicles, which we can argue how environmentally friendly electric battery acid is, for crying out loud. But, but again, that's part of the environmental agenda, is make oil very expensive, so that the people that can't afford to buy gasoline, who also can't afford to buy a new vehicle, will have to buy a new electric vehicle. So forgive me, I go off on a tangent sometimes, but government is very, very rarely the solution to the problems. The free market will fix those on its own merits.
Yeah, I often comment that during the Great Recession, 2007, 2008, while Wall Street took a big hit and nobody liked that, what really hurt Main Street America, rather, is that $5 a gallon gas prices were still sort of lingering from Katrina. It was really a difficult time because we were out of pocket so much for the regular cost of routine gas prices. And it did, again, cause or did not help the case with the market volatility. But Chris, that was now about 12, 14 years ago, and we have gone a long way. We have come a long way. We have advanced in our age and are now that much closer to or making our way through retirement. Would we be able to treat market volatility the same way if we were to see similar conditions? And I know the next downturn is going to be caused by something completely different than the last downturn, but downturns are downturns, and we see the same kind of things, and we see the same investor behavior. Now that we're 14 years later, would we be able to treat it the same way, or what is the right way to handle market volatility?
Yeah, the right way is to make sure that your portfolio is aligned with your risk tolerance when bad things happen. Okay. And bad things, or, bad things in the market, where is what we're referring to. And, it takes all the fun out of it. No question about it. Nobody likes to look at their investment statement and see it down thousands of dollars. It's funny, if your portfolio was down 5%, a lot of people would say, well, I can handle 5%. But if 5% of $1 million is $50,000, people quantify that differently. 5% is something I can handle, but I don't want to lose $50,000 even if they're the same thing. So, trying to help clients manage their, I don't want to say their expectations, but what they think they see on their statements and what is going on in reality. Part of that is investing in the stock market. It does not always go up. That's very unhealthy. Over the course of time, you have some severe drawdowns. That's why you have to advocate for safe money strategies that you and I talk about here, probably once a month on the radio show here for 10 years. And, I've had a number of new prospective clients we've been talking with here over the course of 2022, and the bulk of them say, we just want to get safer. So there's kind of a trend here toward safety, I would think, and just talking to the general population, some of them don't tune into CNBC to look to see what's happening with all the individual stocks, or Fox Business News, or wherever you're getting your information data, the Bloomberg channel. Those are about individual stocks. They're not about creating well-diversified portfolios. And half the people that are talking on those shows are paying a public relations firm to get airtime. And so for for the average retiree here in the United States is, look, knowing what your risk tolerance and doing a risk profile on you is part of the key of what we do as fiduciaries to understand, to say, well, hey guys, yep, you might be down 7%, but it certainly fits within your risk profile. Nobody likes it, but it is a reality of investing. Things can happen very quickly. We've had a very robust marketplace over the course of time, and that we're facing some headwinds, no question about it. The good thing is companies are beating their earnings. If we can get some of these supply chain issues to work their way through, and God forbid we create our own energy here in the United States instead of asking OPEC and our dreaded enemy Russia to create it for us, because at oil, where it's at right now, I was listening to one of the business shows here just recently, and they said that the price of oil where it's at right now, Vladimir Putin makes $1 billion a day. Why on earth are we funding $1 billion a day to basically a sworn enemy, a KGB agent? It makes no sense at all, but that's today's politics.
Well, I do want to comment on the individual stocks versus a well-diversified portfolio, because there's a lot of importance there. And yes, we could pick some winners and hit some home runs, but I heard a great analogy that buying an individual stock takes on more risk, whereas a well-diversified portfolio, while the payoff may not necessarily potentially be as great, it is more likely to succeed. And when you talk about people moving safer or more conservative, I think that that's what the hope is that we increase the likelihood of success with our approach in our finances and achieving those financial goals. The problem comes when the expectation of what success means does not necessarily meet reality, Chris. And I know for a lot of the risk takers that we've been taught to be, we've been told that it's fair to expect a 10 or a 12% rate of return. Again, kind of separating out fact versus fiction and reality. What the case is does not bear that out, at least not over the last 20, 21, 22 years or so. You've got a chart showing every 15-year period since 1996. So 11 different complete 15-year periods, and the average return for all 11 15-year periods running from 1996 to 2010 all the way up to 2007 through the end of 2021, the average rate of return is only 5.03%. So call it 5%. Chris, if we've got a plan that is based on an expectation of 10 or 12%, and then in reality, a well-diversified index of 500 different companies is only bearing out about 5%, we are really off trajectory after a number of years of that occurring.
Yeah, and it's sometimes the perceived rate of return versus the real rate of return over that long haul, Peter. You're exactly right. And as an investor, as someone getting ready to go into retirement, that's why it is so critical to solve some of those basic income needs outside of a risky, volatile portfolio, and then position the rest of the balance of your investments around your overall risk tolerance. And I have a lot of folks that will come in and say, look, I don't like annuities, I don't want to be in annuities, and it's like, all right, I get that, okay, but let's take an objective view. If we can help you solve your basic income needs using a safe, quality, high, good annuity, then the rest of the money you have in your investment portfolio isn't needed for that. That's some of the extras in life. Man, you take a lot of the emotion out of having to make knee-jerk reactions because, the market fell and I'm taking money out of my portfolio. So gives you some additional flexibility. We find that adding the annuity gives us greater flexibility. And, regardless of what you see on the television and some TV commercial that might, may have an unfavorable opinion of them, look, you and I aren't fans of variable annuities, Peter, in all fairness, because we don't like the expenses and the risk associated with them, but there are safe sides, and we use a fair amount of those in our practice when it makes the most sense. But it's the hedge stock market risk, bond market risk, and help solve income needs as well for people.
I heard the comment, Chris, that I would like to have the confidence in retirement in my income to continue to treat my investments as investments rather than as an income source. If we rely on the market to generate that income, it's unpredictable, and it is subject to forces beyond our control that often and frequently do fluctuate. So if we've got the income base in place like we had during our working years, we can continue to act with our other money as we always have, and treat it as investments rather than worrying if that income source is going to generate what we need.
Yeah, no question about it. And, I had a client that was talking to me through some of this recent volatility, and we use a number of different dividend paying stocks to help him with income, and was asking about the volatility. And I'm like, we can handle the volatility here because we're just living off of the dividend. And, as the price of those stocks go down, we may actually buy some more of them because we get a higher dividend yield buying them at a lower price. So, and they understand that, this particular investor. So again, if I'm buying stocks for dividends, I want to rely on high quality companies that are guaranteeing the dividend versus the price of the stock to go up and then I can sell that to create income. So a growth stock versus an income stock are very critical right now. And then, as we look into 2022, after some sell-off here, value stocks may begin to take hold, because there'll be some high quality companies that get caught up in the sell-off, so to speak, and present opportunity. But you got to be in the market to be able to, when it turns, and have that in there, or, getting too crazy and going too much into cash, you miss a lot of those opportunities. And, we've done some research previously on, getting out of the market and then missing the first 5 days of a recovery, how much that cost you over the course of time, because those are typically very large recovery numbers. You might miss 4 or 5% recovery in a week's time after a sell-off because you were in cash. And, where if you were in the market, hey, those companies may have paid a dividend, while you were still invested in them. And that dividend may have bought more shares while they were at a lower price. We're sitting in cash doesn't do any of that.
Yeah, not timing the market, but time
Yep.
in the market. But we've got to have confidence in that. And savvy, effective investors, Chris, are confident in their income and understand there will be fluctuations and volatility with the market and with investments. And they understand that downturns do happen. Unfortunately, we seem to have recency bias, and I heard a lot of talk after 2007, 2008, how the younger generation wasn't getting started investing because they were scared of the risk of the market. And now, over the last 10 years, it seems like we can do no wrong in the market. And a lot of people are taking more risk under the pretense that bear markets are rare and that bad markets happen quickly and snap back just as quickly. And Chris, really neither one of those are true.
Yeah, you're exactly right. And, the opportunity of having that diversified portfolio is certainly paramount in the success of long-term investing. And Pete, I'm going to go back again to this 24-hour news cycle that we have, that people want to react so quickly. And, they heard Kramer say this on the news channel, and Kramer said that on the news channel, that, they're getting all the noise, if you will, from the outside places, really skews some of the logic of long-term investing. And look, we get that, but most of the people listening to this radio show today don't own any individual stocks at all. Most of them own mutual funds or exchange traded funds, and they may have a scattering of some individual stocks, but by and large, the average American investor doesn't put all their eggs in one particular company's basket. They have it diversified. They own some bonds in their portfolio, and they own commodities, and they might have real estate, so they do have well-diversified portfolios. And that's why you do that, because of crazy times in the marketplace, to allow you to not make knee-jerk reactions and pull out and miss golden opportunities on the other side of it. Doesn't mean it doesn't hurt. I get it.
Once again, we are talking with Chris McIntire, Western Ohio's resource for a common sense approach to planning for your financial, your investment, and your retirement future. If you've got questions, if you've got concerns, if you are worried about the volatility of the market or the risks that you are taking, the possibility of losses of your life savings and your retirement accounts, if you're worried about the fees that you may be paying, the taxes that you may be liable for, how to optimize and construct a retirement income plan, the order of operations, and which to access different sources of income, Social Security, pension, personal assets. Of the personal assets, which accounts first? Chris McIntire can sit down with a strategy session and help you map those things out, run an analysis, and get a better understanding of all aspects of your money and how it's working to help you achieve and accomplish your goals. All you need to do, pick up the phone and give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, we've all heard that past performance is no indicator of future results, but again, separating a little bit of fact versus fiction in the market and with the market, is past performance even a good indicator of past results? We see these mutual funds that advertise a certain past performance and rate of return. And when we look at the performance that our money has actually experienced, sometimes they don't match up.
Yeah, you're exactly right, Peter. And the average rate of return and the real rate of return are different. And I think you and I have done this analogy a number of different times here on the show. Is if you had a mutual fund with $10,000 in it and it lost 50% of its value, you have $5,000 left. If it gained 50% the next year, you have $7,500. So percentage wise, it gained back everything it lost, except you have less money in it because you made 50% on $5,000. And then if the market went back up another 33%, right now you're back at just about that $10,000 threshold. So you had a negative 50, a positive 50, and a positive 33. That's an 11% average return in 3 years. And you have the same amount of money as you did 3 years ago.
Math and numbers can be a little complicated, maybe even a little bit more complicated on the radio. But the bottom line is, ladies and gentlemen, that past performance, yes, it's not a guarantee or an indicator of future results, but oftentimes it's not even a great indicator of past results during the time that is detailed or the rate of return was achieved over. We need to really look at what our money is doing for us. Is it making forward progress? Do we need to have that forward progress in order to achieve our goals? And is the progress meeting the expectation for what it should be? We can all think of more questions about our money and places where maybe the prevailing wisdom or traditional thinking doesn't meet reality. Chris, the old thinking that we'll pay lower taxes later, I know is one that you've been revisiting a lot with your clients, maybe rethinking that 4% safe withdrawal rate. But I know that there are ways to address those issues.
Yeah, you're right, Peter. As I'm looking through my notes here on the show, as the market falls, that opens up the opportunity to do some Roth IRA conversions on assets that may be depressed in prices. So to your tax point of view there, you're talking about, and, so always look for the opportunities. If something bad's happening in the market, it's like, all right, what could I be doing, to take advantage of this? And for some folks, it's reassessing your overall risk and whatnot. Look, there's going to be headwinds going here into 2022. We're coming out of a pandemic. People are wanting to get out and travel. Still some supply chain issues from, pandemic shutdowns around the globe, right? We have a global economy going on right now. We have some geopolitical issues here with Russia, Ukraine. We've got China talking about the Taiwan thing. So look, sometimes you got to put on the seatbelt and hang on, and we'll work our way through some of these things. Would like to see inflation come down. I think we all would, and have, cheaper gasoline is like a tax cut to us all, and same with cheaper food prices. So that's the part that's stinging right now. Hopefully they can get a handle on that, and then some November midterm elections that's probably going to help us change the direction we've been going here in the last 12 months. And good, bad, or indifferent, but that's probably the reality here in the midterm elections. Typically, the party in power loses a substantial amount of seats in the House of Representatives. And then we have like a record number of politicians not running for re-election, which bodes more into that conversation as well.
Well, a lot of different information covered on today's program, a lot of different information that we sort of need to take in and filter and understand in order to make investment decisions. That's what this all boils down to, is what impact, what effect will this have on my money, the stability of where my money is placed, and volatility in the market. And if you're concerned with what's going on, what you're seeing, or that you may be positioned with more risk than you would really like to have into your financial future, pick up the phone, give Chris McIntire a call. Happy to sit down with you, run that forensic financial analysis, a dig beneath the surface, go beneath the hood and really look at what you own, what its purpose is, what it's doing for you, the pros, the cons, the risks that you're taking, the possible potential for growth and gains, and measuring those things out and helping to find appropriate solutions to help you achieve your goals. Pick up the phone, give a call, 800-868-1194. That's 800-868-1194 to speak with Northwestern Ohio's resource for that approach to structuring the plan to achieve your goals and to your financial future. Chris McIntire and the team from McIntire Retirement Services. 800-868-1194. And Chris, it's been a pleasure. Always some great information and perspective that you share with us and the listeners to your game plan for retirement each week.
Yeah, it's my pleasure, Peter. And, we need to remember in 2018, the last time they raised interest rates, we had a very challenging stock market, bond market, and commodities market as well. So some of that is to be expected.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.